So yeah, let's start with that. Why is gold just offered up right now, given everything that I would imagine would actually boost the price?
We believe gold prices are holding up remarkably well, given the pressures that the market's facing at the moment in terms of the dollar's strength. Such a sharp move in the past, we've seen gold breaching that 1700 level and testing the downside. But here we've seen prices holding up quite well. The physical market's been quite price elastic, but also it's those concerns that inflation may remain elevated for a longer period of time. That hasn't seen tactical investors or ETF investors heavily shorting gold just yet. Yes, they've scaled back their exposure. We've seen hefty net redemptions across the gold ETFs. In fact, July is on pace to be its fastest month of outflows in almost a year since March last year, and tactical positioning has been scaled back close to neutral territory.
But it hasn't, right? Sorry, Suki, we were breaking up there. I have to wonder though, it doesn't have quite in terms of living up to its reputation as an inflation hedge or a safe haven. I wonder then, what would it take then to spark this selling pressure, to actually spark maybe more inflows into some of those ETFs you were mentioning?
We think we've seen the bulk of the downside being priced in. When we've previously seen the Fed hiking at the pace that it has been, and we expect another 75 basis points at the July meeting next week, gold prices could be expected to come under a lot more downside pressure. So if you go back to 1980, where we saw this sort of pace in hiking, gold on an annualized basis lost 20%. But for gold prices to really rally, we think we need to see a few factors come into play. Firstly, a stabilization in those ETF outflows. Secondly, we need to see if that physical market is still price elastic. We're now entering a seasonally slow period for consumption for gold, so that floor is quite vulnerable in the near term. But also we need to see that the market has already priced in a lot of this downside risk. And if we look at that tactical positioning, we can see that it was actually quite elevated with the first hike back in March, but now it's been rapidly scaled back. So we think there's actually scope for a relief rally coming up to the July FOMC meeting, where we could see a little bit of a bounce and perhaps prices edging back towards 1750 in the near term.
Suki, just to look at some of the key risks or developments in industry here as it pertains, I guess, to some of the targets and where prices go. The possible or ongoing, if you will, recovery in the chip shortage. Why is that important?
This has had so many implications for not just the markets directly impacted like platinum and palladium, where it has an impact in terms of global auto production, but also secondary effects in terms of the inflation risks as well. So for the gold market, it's had a secondary impact, in that inflation was expected to start to ease in the middle of this year, but now that's perhaps been pushed out into some point in 2023. And the inflation risks have been exacerbated by some of the supply side challenges that were expected to ease. So now we're seeing central banks raising rates at a much faster pace than was anticipated at the start of the year. But for the PGM market, it's particularly interesting because it's going to be the turning point of the chip shortages that results in the bounce back in global auto production. That's likely to see the industrially biased precious metals start to outperform, say, gold and silver, perhaps towards the end of this year or certainly into the start of 2023. So that's going to be a critical factor in determining that upside risk across the precious metals.
You mentioned a little bit more the demand picture. We've seen in terms of China, there's been a bit up in terms of industrial metals on the prospect of more stimulus. It has helped the likes of silver just a bit. I'm just wondering, there's been reports from Chinese banks that they're going to suspend investors from taking new positions in gold and silver by August. How much does that actually muddy the demand picture for you?
For the entire precious metals complex, China has a varying factor in terms of how critical its demand is. Its largest exposure is perhaps in palladium, but we've already seen a slowdown in palladium consumption coming from China, with a slowdown in auto production. In fact, we've seen an increase in platinum demand, as there's a view that longer term we'll start to see substitution between platinum and palladium, favoring platinum, and that's perhaps been exacerbated by Russia's invasion of Ukraine. But a slowdown in China's demand for the gold and silver market is perhaps more important in determining that downside. At least in the near term, the downside support for gold critical level is really around 1690. And here we need to see responsive interest from both India and China, as well as central banks around the world providing that buffer on the downside. For the silver market, the most of the strength has actually come from India. But I think across the metals complex as a whole, China's lockdown implications, the fact that we might see a slower growth recovery in the second half of the year is critical in determining how solid that floor is going to be the downside. The upside is still very much being driven by the macro picture and the strength of the dollar and when we'll start to see a turning point. And investor interest is already waned. So the physical market is going to be key on the downside.